I think it should be driving institutional interest. I don't hear many people besides us talking about it at the institutional level. This is a theory that Bitcoin has had for a long time at the retail level, but I don't hear it much at the institutional level. I think I'm going to start talking about it more as I travel around. I don't know if Ryan disagrees with me, but I think it's a narrative that still has to penetrate the institutional lens.
A large portion of Bitcoin held by major players wasn't acquired recently. It was accumulated years ago, often under intense skepticism, regulatory uncertainty, and extreme volatility. These positions weren't built overnight, they were built through consistent accumulation across multiple market cycles. This distinction matters. It's not just about capital, it's about conviction and time horizon. Many investors today are still allocating marginal exposure, often around 1% of their portfolio. That's not conviction, that's experimentation. Meanwhile, long-term holders continue to accumulate regardless of price fluctuations, negative press, or macro uncertainty. This creates a structural imbalance between those who understand Bitcoin deeply and those who are still testing the waters.
Yeah, at Bitwise, we've always described Bitcoin as a store of value with an out-of-the-money call option on being a currency or a tool for international settlement. In other words, when you invest in Bitcoin, you make a bet on it being digital gold. And as we've talked about LG, we think that's a very good bet. We think Bitcoin could easily get to $1 million a coin just by making modest progress on being digital gold. But you get this out of the money call option on it becoming a tool for international currency settlement, maybe between countries that don't like one another. We've never really talked to institutions about that because that's such a far off idea, right? No one's really doing it. It's a theoretical concept. So we focus people on this idea of digital gold, but you still do have this international call option. The reason we wrote the piece is because what happened in the Iran conflict is that call option both came closer into the money because Iran talked about tolling ships paying with Bitcoin. That's like the first example of this happening. But then also importantly, the global monetary order just got more volatile, right? We're talking about a country that's situated between the US and China. It has complicated relationships with all different kinds of adversarial countries. Maybe you don't want a political currency or currency rail like the dollar system or the yuan system. It shook that up. And one of the things you know about options is if the underlying market gets more volatile, the option gets more valuable. And so what we think happened there, the reason we think geopolitical crisis plays into Bitcoin and in fact drove its outperformance is that the global monetary order got more volatile and therefore this out of the money call option became more valuable. So you're not just talking about digital gold, you were talking about Bitcoin as a currency. That's two bets in one. They're both bets that can lead to $1 million plus outcomes. So it made me think that our price target, which is 1.3 million by 2035, is too low. Maybe it should be 3.3 million. I think this idea of an apolitical currency is coming into the money and the volatility is increasing as the world gets more chaotic. And I think that just plays right into Bitcoin.
Does that rely though? Would that rely on more geopolitical conflict?
Well, it would rely on the world becoming less hedged to individual political currency rails, right? So I think these things break and actually are never put back together. So like the US seized Russia's treasury assets. I don't think you band-aid that over and all of a sudden countries are like, okay, I'm okay with you having my wealth on your balance sheet. I don't think that genie goes back in the bottle. So does it need more geopolitical conflict? I'm not sure. It needs more growth of non-dollar economies. And I think the passage of time, but certainly I think geopolitical conflict will accelerate this. So yeah, in the end, I think it's a little bit of a hedge against this geopolitical. I think it should be driving institutional interest. I don't hear many people besides us talking about it at the institutional level. This is a theory that Bitcoin has had for a long time at the retail level, but I don't hear it much at the institutional level. I think I'm going to start talking about it more as I travel around. I don't know if Ryan disagrees with me, but I think it's a narrative that still has to penetrate the institutional lens. I don't know that it's been verified that it has.
I don't know.
I agree. But I think the point Ryan is making is a great one.
Yeah.
Which is it's actually not a binary outcome. It's not like will China settle transactions with Russia in Bitcoin?
Right.
That doesn't have to happen before the market recognizes that it has the probability of that increased from something like 1% to 10%. I would argue that that definitely has happened. It's now been raised as an idea by Iran in difficult geopolitical situations where you're pegged between the US and China. You default to this apolitical asset. The probability of that happening again in the future has gone up. And I think that's why you're seeing the value of Bitcoin going up. Again, it doesn't have to get all the way there. It just has to increase in probability. And I think that objectively has happened. So my experience of these reports is Ryan and the team puts them together. And then when they're nearly ready, they ship them to me to review. And usually when I go through the data, there are some things that are up, some things that are down, some assets that went up, some assets that went down. Q1 was just brutal across the board. Every major crypto asset down double digits. Most major crypto stocks down double digits. Almost every on-chain metric that you looked at down significantly. The only sort of silverish lining was some positive news on stablecoins. But in how many years have we been doing this quarterly report, Ryan? 3 or 4 years? 3 or 4 years of reviewing this. This was the most down-only data report we've ever produced.
Wow.
The flip side of it, LG, is that the news was so good, right? Market down, Morgan Stanley launching a Bitcoin ETF, market down, Goldman Sachs launching a Bitcoin ETF, the SEC unveiling a token framework. I mean, it was just relentless good news. And what it really hammered home to me is like, look, this data is backward looking. Backward looking really was bad. The question is, all the news flow is forward looking. Will it drag up the data into Q1? I think that's what people are, Q2, that's what people are betting on. And that's why the markets have rallied the last few weeks.
One of the most underappreciated dynamics in the Bitcoin market is how many participants don't actually understand the asset they hold. Historically, there have been early adopters who exited Bitcoin for alternatives they believed were superior. In hindsight, many of those decisions reflected a lack of fundamental understanding rather than a strategic reallocation. This pattern continues today. Some investors treat Bitcoin like a high beta tech stock, reacting to macro news, liquidity shifts, or geopolitical events in ways that contradict Bitcoin's core value proposition. For example, selling Bitcoin during geopolitical conflict doesn't align with the concept of neutral, censorship-resistant money. In theory, periods of instability should strengthen Bitcoin's case, not weaken it. This disconnect highlights a broader issue. Ownership does not equal understanding.
You know, look, our view of the L1 space is that we're very early. I mentioned earlier that we're going from, 20 billion to whatever, 600 trillion. And so when we look at new projects, what we want to see is L1s with differentiated architectures and some sign of real world traction. So Ethereum has one architecture and obvious massive traction. Solana has another architecture and obvious massive traction. We have big ETFs, ETHW and BSOL in Ethereum and Solana. Avalanche is this third unique architecture, right? Their use of customizable Avalanche L1s that individual corporations can build with their own permissions, their own fee networks, etc., is a unique architecture. And when you look underneath the surface, they're making real traction in real world assets, right? RWAs on Avalanche up almost 1,000% year over year. They're one of the L1s that are making traction. So I don't know how the L1 environment will play out over the next 5 or 10 years, but I know it will get much bigger. I want all the legitimate shots on goal that are leaders with their architecture. I think you're looking at Ethereum, you're looking at Solana, you're looking at Avalanche. We don't have a Canton Networks ETF, but you're probably looking at Canton, right? There are just a few, there are only a handful of these really interesting architectures with real world traction. Avalanche is one of them. So we launched BAVA, BAVA, that's our ETF. And we're excited to get it out there. Illegal securities offerings by scammers. Right. But the idea of using valuable tokens to incentivize community activity to build new networks and solve the cold start problem is a very interesting entrepreneurial idea, maybe one of the most interesting ideas. And the fact that we can now do that in a regulatory compliant fashion, just because something didn't work under the past format doesn't mean it won't work, right? Like I just ordered pet food from Chewy, but pets.com definitely failed. It was just not at the right time. I think tokens failed because they were not at the right time, but I do not think that means they won't work in this new environment of highly performant blockchains, of a strong regulatory environment, of AI enabling people to do things, I do think there'll be a new boom and new interesting projects over the next 18 months. I always thought that the ideas that we experimented with in 2018, in 2020, and 2021 were good ideas just at the wrong time. I thought the idea of solving the cold start problem through crypto incentives was a good idea, but handicapped. I thought many of the DeFi projects were really great ideas, but handicapped by the lack of highly performant blockchains. And having been around through like the internet boom, you know that it takes regulation and technology and the right market conditions in order to have these two things. So I've sort of had this thesis that everything we've tried in crypto will work. It just wasn't working at the specific time. So I do think that this is an eventuality, and I think it's going to catch many people off guard. Yeah, absolutely. That is designed for click farming. I'm pretty proud of it. Look, the thing about the token framework is really interesting, right? So if you think about the history of crypto and alt season, what entrepreneurs have tried to do is build projects with tokens that capture some form of the value, right, to incentivize community development or do interesting things. But we've always been kneecapped in that approach by the fact that the previous SEC would put you in jail if you succeeded in building a token that had value. So we had these goofy governance tokens, and everyone sort of wrote off the idea of using token infrastructures to incentivize people to create a new network and build a new thing. Paul Atkins, the SEC chair, comes from a lobbying background that included lobbying specifically for tokens. And I think he believes in the ability of tokens that can capture real value to incentivize new networks that are economically important. And so he's created a safe harbor for people to start experimenting with that. When you take that new capability, which I think will surprise people because they sort of remember it not working, I think it will work in this new regulatory environment. And then you take the new capabilities of AI, which allow people to do much more with fewer people than they have in the past. And you smash those together, I can just see a million sort of flowers blooming and new ideas blooming of actually valuable token projects. Look, I think there's this idea that tokens don't capture value. We're starting to see proof points that they can. Look at Hyperliquid. And now you have a token framework that allows you to do that in a legally compliant manner. I think we're going to see a huge new wave of innovations, a new ICO boom. I think all of that is going to come back, but this time some of it's actually going to work.
There's a common assumption that there is always ample Bitcoin available for purchase. On paper, exchange balances may suggest millions of coins are accessible. In reality, most of that supply is not for sale. It is tied up in market-making operations, collateral structures, and trading strategies. It functions as liquidity, not inventory waiting to be permanently transferred. At the same time, new supply is extremely limited. Bitcoin issuance is fixed and predictable, and after each halving cycle, the flow of new coins entering the market declines significantly. Now combine that with a new and powerful force, sustained institutional demand.